Elon Musk is worth over $200 billion, and most years, his official income is close to nothing. No paycheck, no massive stock sales splashed across the news, and yet he lives like a man worth $200 billion because he's found a loophole so simple it's almost insulting. He never sells, he borrows. Welcome to Outlaw Wisdom. This is Hidden Rules the Wealthy Use, where we expose exactly how the game is played, who taught it to them, and why nobody ever taught it to you. Here's the rule. It has a name inside the financial world. They call it buy, borrow, die. And once you understand it, you'll never look at a billionaire's tax bill the same way again. Let's start with the problem the wealthy actually have. You'd think being worth billions solves every money problem you could ever have. It doesn't. It creates a new one. Because almost none of that wealth is cash. It's stock, shares in a company, sitting on paper, worth a fortune on the screen, and worth exactly $0 in your pocket until you sell it. And here's the trap. The moment you sell, the government taxes you. In the United States, sell a large block of appreciated stock, and you can lose 20 to 37% of it instantly to capital gains tax. Sell enough, and you're handing over hundreds of millions in a single transaction. So the ultra-wealthy looked at that problem and asked a question most of us never think to ask. What if I never sell at all? Here's the first law of this strategy. You are only taxed on income you realize, and a loan is not income. If a bank hands you $100 million, that's not a paycheck, it's debt. And debt isn't taxed. Not today, not ever, as long as you don't sell the asset backing it. So this is exactly what they do. A billionaire walks into a private bank with a portfolio worth billions in company stock. The bank looks at that stock and says, "We'll lend you money against it." Not because they're being generous, because the stock is the safest collateral in the world. These loans often come with interest rates lower than a regular mortgage, sometimes under 2%, sometimes even less for the biggest clients. And the billionaire takes that cash and lives on it. Buys the house, buys the yacht, funds the next company, all without selling a single share and without triggering a single dollar of capital gains tax. Here's the second law. The bigger the asset you can pledge, the cheaper the money gets. It's the exact opposite of how debt works for the rest of us. When you or I ask for a loan, the bank worries about whether we'll pay it back. When a billionaire asks for a loan against $2 billion in stock, the bank isn't worried about anything. The collateral is bulletproof. So the rates drop, the terms get better, and access to nearly unlimited cash becomes almost frictionless, completely disconnected from anything that looks like income. Now here's where it gets almost unfair. While that loan sits there, the stock backing it can keep growing. Doesn't matter if the market goes up 10% a year. The debt doesn't grow with it. The asset does. So the billionaire's real wealth is compounding in the background, completely untouched, while the loan just quietly sits there, being paid down slowly or sometimes not paid down at all. And then comes the final brutal piece of the strategy, the part that gives it its name, die. Because in the United States, when you pass away, anything you leave behind gets what's called a step-up in basis. Your heirs inherit those shares of stock at their current market value, not the original price you paid decades earlier, which means all that growth, all those decades of gains that would have triggered massive capital gains tax if sold during your lifetime, it can legally disappear. Wiped clean. The heirs can then sell the stock, pay off whatever loans remain, and keep the rest, having paid little to nothing in tax on gains that took a lifetime to build. Buy the asset, borrow against it instead of selling, die, and let the tax bill vanish with you. That's the whole strategy. 3 words, and it's completely legal. Here's the third law, and it's the one that should actually make you angry in a productive way. This isn't a secret. It isn't hidden in some offshore account or shady scheme. It's sitting right there in tax law, available to anyone with enough assets to use it. The system was never designed to be a secret. It was designed to require scale. And scale is exactly what most people were never taught how to build. So can an ordinary person actually use any of this? Not at the billionaire level, no. You're not walking into a bank tomorrow and borrowing $50 million against a stock portfolio you don't have. But the underlying principle scales down more than you'd think. If you own appreciated assets, stock, real estate, a business, you can sometimes borrow against them instead of selling, especially when you need cash but don't want to trigger a taxable event. A home equity line against real estate you already own. A securities-backed line of credit against a modest but real investment account. The tools exist at smaller scales too. Most people just never learn they're available because nobody built a system to teach it to them early. Here's the lesson underneath all of it, and it's the one I want you to actually walk away with tonight. Selling an asset isn't the only way to access its value. And once you understand that, you start looking at your own financial life completely differently. You stop asking, how do I cash this out? And start asking, how do I use this without giving it away? That single mental shift from selling to leveraging is the real hidden rule. The billionaires didn't invent debt. They just stopped being afraid of it and started making it work for them instead of against them. So the next time you hear that some billionaire paid almost nothing in taxes this year, you'll know exactly why. They didn't cheat. They didn't hide anything. They just never sold. If this exposed something you never knew, comment "borrow" below. Next time, we're testing something even older, an ancient money rule that told people to split their wealth into exactly 3 parts, thousands of years before modern financial advisors existed. Does it actually hold up against inflation in today's markets? We put it to the test, like this video if the rules finally make sense. Subscribe if you want the next one exposed. Until then, stay wise, stay free, and remember, they were never hiding this from you. They just never taught it to you.